In this video, we're going to continue talking about bond valuation. And in this particular version, we're going to look very closely at how you calculate a value. Remember that value and benefit are similar, right? The value of an asset is the benefit you think you will receive if you purchase it. We certainly want to compare the benefits we get to the costs of acquiring those benefits. So all bond prices are determined by the present value of their cash flows. Now this is made rather simple for bonds, unlike when we talked about stocks, because we know exactly what the cash flows of bonds are going to be. So the yields, the returns of bonds, as I mentioned a little bit earlier in another video, the yields that you would expect to receive are basically determined by investors, right? We are buying and selling bonds now, and that buying and selling creates the price. And that price converted to yield says that, look, a AAA rated bond right now averages around 4%. If you were going to buy a AAA rated bond, what yield would you expect to get? You're going to expect to get very close to that 4%, right? So if we have an understanding about yields and prices, and then we know something about expected interest rates, we know what kinds of bonds to buy. So if you expect interest rates to increase, that means you expect the yield to increase, which means you expect bond prices to fall. Since you don't want to lose a lot of money, you want to save or protect some of your wealth, you would want to buy short-term bonds. As we'll see towards the end of this video, that this strategy will help us manage some of the returns that we ultimately receive. So when you buy a bond, you get two kinds of cash flow. You get the coupon, that's the interest income, and you get the principal. And again, as we talked about earlier, right, since you know what these are, it makes the calculation actually a little easy. So the bond value is the present value of coupon payments plus the present value of principal, and I should have spelled principal correctly, plus the present value of principal. We're going to assume annual compounding. Now, in reality, most bonds pay interest semi-annually. It really doesn't make a distinction with the process. As you'll see, there is a box where you can change the compounding from annual to semi-annually just by changing the value in that box from a 1 to a 2. But we need to understand something about the coupon. We need to know the par value. That's almost always going to be $1,000. How many years are remaining to maturity? And we need to know the prevailing market yield for that discount to use as the discount rate. But again, this is based on the riskiness of this particular bond. In other words, it's its credit rating, its bond rating. So here we have an example. It's a $1,000 par value 20-year bond, pays 9.5% compounded annually, when the market rate is currently 10%. Now we're going to use the bond valuation worksheet. So if you look at our yellow boxes, what can we put in here? These are the only numbers that fit in these boxes. Par value, that number is almost always going to be 1,000. The coupon is 9.5%. The coupon per period, well, you just take that number, divide it by compounding frequency. So for this bond, it's either going to be 9.5 because it's annual, or you would divide that by 2 and it would be 4.75. The required return, this is the yield of similar risk bonds. It's 20 years to maturity. So the value of this bond is $957.43. So that is the most you'd be willing to pay to purchase this bond. Now what happens is, and I'm not so particular that we understand exactly how the math works here, but what happens if you buy the bond in between coupon dates, right? So if the coupon was supposed to be paid last month and it's paid every 6 months, a month has passed, so the person who owns the bond now is entitled to 1 month's interest. If you'd held it for 3 months and now you want to sell it, you're entitled to the first 3 months' interest. But the interest isn't going to be paid till the end of that 6 months. So essentially what we have is something called accrued interest, right? This is the amount that you've earned since the last coupon payment. So the clean price of a bond equals the present value of its cash flows. That's what we just calculated a second ago. The dirty price of a bond is that clean price. It's its value plus the accrued interest. So again, it's just a matter of adding whatever the accrued interest is to the bond value to determine the actual price you'd be willing to pay, or that you'd have to pay, to buy this bond. So let's now change our picture and think a little bit more about yields. There are essentially it says 3, there's 4 yield curves that are very frequently used, and one is just a common quick look, if you will. So the current yield is just a very quick look, right? It's not a real difficult calculation, but it just gives us a picture of what the first year's return would be if we'd hold this just for 1 year. But for long-term investors, we're really interested in these 3 widely used metrics: the yield to maturity, the yield to call, and what we're going to refer to as the expected return. So let's work our way through these. The current yield is just the coupon divided by the price. It's very simple to calculate, right? It only looks at one source of return. So it only looks at current income. So for this year, again, if the coupon was $100 and if the price was $1,000, the current yield for this year would be 10%. Again, it really just gives us a very quick picture of potential return. The yield to maturity asks a more complete question. If you buy the bond today and you hold it to maturity, what is the average rate of return per year that you'd earn on this investment? So it's very important. It's a widely used measure. Sometimes they refer to it as the promised yield. But again, this is what you earn if you buy it and hold it to maturity. Another phrase, more of a corporate finance phrase, would be the internal rate of return on this bond. But it's just a return picture. So let's come back to our bond. Let's assume that the bond price is $935. If the bond price is $935, the current yield is 10.16%. That's $95 divided by $935. It's a little bit more than 10%. The yield to maturity, if you pay $935 and you hold this for 20 years, getting $95 a year in coupon, you would earn 10.28% on your investment. So what's the difference between these two numbers? The difference is the additional yield that you get from the other 19 years, right? So you get 0.16, 0.28, this 0.12% is the additional yield you get if you hold this for the entire 20 years. And this is per year. It's not in total, it's per year. So yield to maturity, right? Those the properties, things we need to understand about it is you only get this if you hold it to maturity. It assumes that you reinvest all of the coupon payments for the remainder of the life of the asset, and it also assumes that you reinvest your interest income at a rate equal to the yield to maturity, right? So again, the idea here, if you think about this coupon, right, to get compound return, you have to get interest on interest. So you have to reinvest when you get it, and you have to do that for the lifetime of this bond. Now, yield to call is another picture. We've talked about this in a previous video. We've talked about a call feature. So yield to maturity is not always good if the bond can actually be called prior to maturity. So yield to call, YTC, talks about the yield if you buy it at today's price and if it is called on the first date of call. So the length of the investment horizon now is the number of years to the first call date rather than maturity. And of course, you're going to use the bond's call price premium instead of the par value. So we can do this a number of ways. The way that I provide in the spreadsheet so that we can look at all of these multiple return calculations is I've created a box where you put the call premium, that's 1 year's interest plus the par, and this bond can be called 5 years from now. So the yield to call is 12.8. The yield to maturity is 10.28. So you would like it if the company would call this debt. You would get a higher yield on your investment. So what has to happen for the yield to call to occur? Well, interest rates have to decline. The company must want to refinance its debt, and it only does that when interest rates go down. So interest rates would have to go down far enough so that it would be profitable and viable for the company to want to refinance that debt. Again, since we have predictions now about what we think is going to happen to interest rates, do you think this makes sense or not? Will interest rates fall? If they fall, will they fall far enough so that now the bond could be called? So that's the end of this video. We're going to continue talking about more return calculations, and we'll also talk about some strategies with respect to bond investment.